shortly have Jason Lindsay from Octagon joining us as well. And so topic today is currency hedging. And as I said briefly before, it's a great topic, this one. There's different approaches to it. And as always with the investment management industry, there is no right answer. There's just different ways of doing things. And I'll be interested to dig into the sort of thought and approach that the different groups are taking that we've got represented here today. For Marek and David, I was going to tie things back largely. Well, firstly, you can do what you like, but I'll sort of push questions towards your diversified funds as well, your growth funds, because often it's just a good reference point. That said, feel free to talk about what you might do within a specific global equity mandate in relation to currency hedging. But if we start with you, Marek, at Mint, do you want to tell us within the funds that you're running, what you do around currency exposure, what your approach is?
Sure. So we have 3 diversified funds, but for currency exposure, I think growth fund is probably the most significant, as we have 60% of our assets in global equities. And for us, our policy is to be fully hedged. We do have some ranges around it, but we most of the time aim to be 100% hedged. The main reason for us is really the fact that we have New Zealand-based investors, and what we can show over the last 5 years in the growth fund, we are doing a very good job picking stocks. So we can show the data. We have a data that supports that. But we are not currency specialists. So I think clients who appoint us for our abilities to identify best stocks. So I think that would be a brief summary of where our position is.
Yeah, no, I'll have a follow-up question for you later around that, Marek, because I'm acutely aware that there's different sort of ways that you can hedge around how you think about your stock positions as well. So I'm certainly keen to come back and revisit that with you. What about you, David, within the Smart Shares portfolios? I know recently you made a change, I think if I get my math right, you increased your currency exposure, right? Because you've sort of gone from being somewhere like 70% hedged to somewhere closer to 50. But why don't you tell us, rather than me guessing, why don't you tell us what you're doing? I'll just take a second to welcome Jason Lindsay along. Jason, apologies for the technical issue. We've just jumped into things. I'm asking questions, and we're sort of linking answers back towards like diversified growth type funds, but really you can answer in any way, shape or form. So I've just fired a quick question at Marek, who fully hedges their currency exposures typically, and David was just about to get into telling us about what he does as well.
Thanks, Anthony. So I guess I'll start off just saying that Smart Shares has that wide range of products available. So we've got those single sector funds, which are largely index tracking funds, and they'll do what the index does, and then our diversified funds invest into a mix of single sector funds. And so when we consider currency hedging, we're really looking at what asset classes are in that diversified fund and the currency hedging per asset class. So, for instance, for the international fixed interest, we'll hedge that 100%. For the international property and the international infrastructure, which has those bond-like characteristics, we'll also hedge 100%. And for international equities, we're currently hedging 50%. So as you said before, over the last few years, we have brought that hedging ratio down from around that 70-75% level down to 50% as that currency's come off.
Yeah, and so if you had like a growth fund, I assume you've probably got relatively large exposures to global equities within that, and you're saying 50% of that's hedged.
Yeah, correct.
Yeah, whereas Marek was at the 100% typically inside of it. So yeah, great. So 2 different approaches there, and I'll have some follow-up questions around how you think about elements around that as well. What about you, Jason? What are you doing with currency hedging?
Thanks, Anthony. Sorry about the lateness.
No, I think it was at our end, mate.
Yeah, well, I spent a couple of hours kind of trawling internet, and most of our peer funds offer either a fully unhedged product or close to fully hedged, not hedged product. So here at Octagon, we offer a different solution whereby we assess the hedge level of the portfolio at least monthly, often more frequently, depending on where the New Zealand dollar sits against a basket of currencies that make up the bulk of the underlying investments. And broadly, I guess you'd describe our model as a dynamic hedging model. We have adopted a ladder approach where we can achieve better risk, we think we can achieve better risk-adjusted returns, and indeed in the back testing we've performed over a long period of time, we would have. And kind of we all understand the theory that running with an unhedged portfolio provides a cushion against global shocks as asset values collapse. The New Zealand dollar in particular against the US tends to go with it, and we saw that play out exactly as you would expect during COVID. So from late December 19 to the COVID lows of 23rd March 2020, which you might remember as a rather stressful day watching the markets while everyone else was out stockpiling toilet paper. But during that almost 3-month period, the S&P index fell 31%. And at the same time, the New Zealand dollar fell almost 16% against the US, meaning if you were running with an unhedged portfolio, approximately half your losses would have been protected. And although our benchmarks that we measure Octagon offshore funds against are 50% hedged, and our SIPO requires us to be between 20 and 80% hedged, both of which still remain in place. I've been in the business a matter of months, and the policy up to then had been to be at the kind of lower end of the hedging levels. Indeed, we were closer to 20% hedged in that quarter, and therefore our investors did benefit from the collapse of the New Zealand dollar, in particular versus the US. I think it went from 67 cents to 57, and we added to the hedging, but not enough. And we saw the currency go all the way back to 74 cents over the next year. So that got us thinking that there must be a more systematic way we could manage our currency risk. So back in 21, we developed and implemented a hedging framework that we call the ladder. And it builds on the belief that the New Zealand dollar mean reverts to the real value of the purchasing power of two currencies. And we adjust our positioning of the hedge when the currencies trade at certain degrees of standard deviations away from the fair value. So at fair value, we'll be 50% hedged. And then when the New Zealand dollar is X number of standard deviations cheap, we'll be 80% hedged. And when it's X number of standard deviations expensive, we'll be 20% hedged. And we interpolate between the two, and we source those fair value estimates from a major commercial bank after we back tested that with our performance.
Yeah, and so Jason, am I right as a summary that, say, for your growth fund within its currency exposure, it would come through your global equity exposure predominantly?
Yeah,
and
I mean
and your benchmark's about 50%. Your benchmark's 50 on that, but you're quite happy to 50% hedge. So if you've got in a growth fund, say you've got, I don't know, 50% global equities, currency hedge position at benchmark would be 25% for the total growth portfolio, but you're quite active around that depending on how over or undervalued you perceive the dollar actually is.
Yeah, so we hedge the within the global equities part, which, as you say, for a growth fund might be around 40% of the fund.
Right.
The US dollar, the euro, the Aussie, and the yen, using proxies for some currencies, and that combined covers about 93% of our offshore equity exposure in our global fund. And if I just look at the Kiwi US, for example, that's ranged from, if I look back over the last 18 months, we've been up to 77.5% hedged back in October 2022 when the Kiwi US was 56 cents, and then back down as low as 62.5% hedged in January 23, which was only a few months later, when the Kiwi strength back to 65.
Yeah, cool. Okay, and we'll come back to sort of some of the thinking around that active management as well as we go. Jason, why don't you quickly, within the Foundation Growth Fund, what are you doing there around currency hedging?
Yeah, thanks, Anthony. So I guess within the Foundation Series growth and the Balance Fund, obviously would, like most other managers, hedge bonds 100%, in view of the fact that they're defensive in nature. We don't really want the currency movements to sully that. But within the global equities, we primarily take a passive approach because the funds are really passive. I mean, we have a little bit of active managers and part of the underlying fund manager suite. But for the most part, the Foundation Series aims to be low cost, tax efficient, passive exposure for customers. So in view of that, we do really see solid and really compelling arguments for both sides of the hedging or versus unhedging, hedge versus unhedged equation. I guess I'll talk a little bit about what we think is probably the most compelling on the hedge side, at least. I think it's really the fact that we can target a pure equity exposure, with the fund being primarily passive and a lot of our investor base is retail. When they invest into the funds, they really expect that they're getting basically full exposure to the market only. So, I mean, you can ask our InvestNow customer service team how many questions they get a day of like, oh, the S&P went up 5%, over the period, and why is my fund return only 3%, right? So obviously that's the impact of, the currency movement as well. So from that perspective, we do aim to cater our funds to what the end investor expects. So that's, a really strong reason to go hedged in that perspective. I mean, there is another kind of school of thought that from another argument in the hedging camp would be that the fact that as New Zealanders, we do spend all our money in NZD as well. So it makes sense to kind of keep all the returns in NZD terms. From our point of view, though, we don't think this is a very compelling argument. In fact, we feel like the fact if you're looking to base your current foreign currency hedging policy based on the spending habits of the average New Zealander, it's almost an argument against going hedged because a lot of our spending is actually determined by foreign countries and foreign currencies. So, for example, the average New Zealander, although would spend our money or New Zealand dollars when we're buying, gas, food, electronics, a lot of those markets are actually determined not by the New Zealand market, but by foreign. Oil is USD driven, food is, and dairy is all impacted by the global markets. So from that perspective, when you're investing, a lot of investing, if you really boil it down to it, it's just matching, your current assets, i.e. your investment portfolio versus your future liabilities, right? So future liabilities could be you're saving for retirement, could be saving for that house, could be you're saving for, that big holiday overseas. So all those future liabilities are really denominated and impacted by foreign currencies. So to match those foreign liabilities, it makes a lot of sense to actually have foreign currency exposure and then therefore go unhedged. So, we really see the compelling arguments on both sides. And from that perspective, we basically took a balanced approach and just went 50% hedge, to kind of get the benefits of both ends. Kind of notwithstanding that, obviously, we have some single sector funds that we do offer both hedged and unhedged versions because we do appreciate that a lot of customers may have a specific view on which way they want to go. And then by having a fully hedged and fully unhedged option in the same fund, you can basically tailor that approach fully to, what your specific views are. And I'm sure, Marek, David, and Jason will have very compelling arguments as to why you will want to go one way or the other.
Yeah, no, that's cool. And also, I suppose, cheekily in creating the Foundation Series funds, you've also got an eye towards being in the midst of being low cost in the middle of the competition, so to speak. And typically a lot of funds are 50% hedged on average when you look at growth funds and things. So it's a pretty no regrets point to be at, right? Whereas going back to you, Marek, in terms of that, because obviously, Jason's got a real point of difference there in terms of the activeness that he brings to it. But in yours, I was interested because you talked about, your real primary focus on stock selection. And again, there's no right or wrong answer here. Do you hedge, like if you're thinking just of global equities, do you hedge the currency by hedging out the benchmark exposure? Or by that I mean you sell a basket of currencies in accordance with the benchmark weightings? Or do you tend to try and mirror off the portfolio? Because, it's sort of, a nuanced question to thinking about how you think about your stock selection.
Yeah, so our benchmark is 100% hedged. So that's the benchmark of the fund.
Equities. Yeah, sorry. Yeah.
So therefore, we would be hedging equity exposures in the portfolio based on our portfolio positioning. But the point is that we both both benchmark and portfolio are fully hedged. Now, I just to give you an idea why we think that why we think the fully hedging approach is the appropriate one. So obviously, I know that a lot of we can only look at the data that is available, right? And we can say that we do a very good job of selecting stocks. Now, if you think, obviously, I have no way of telling whether if someone's talking about active or dynamic hedging, whether that actually adds value, and perhaps it does, but that data obviously is not publicly available anywhere. But we clearly had a look at the different ideas on dynamic hedging. So it's not like we've just decided to go 100% and never done any proper research. But even looking at the data that is publicly available, so if you look at HFRX Active Currency Hedge Fund Index, so that's an index of all hedge funds out there who primarily specialize in currency, and that's all they do. Over the last 15 years, they made around 1.4% per annum, and that is all pretty much driven from 2022. Excluding that, all those funds have made, on average, less than 1%. So these are currency specialists. I think that so just to the Jason's point about New Zealand investors being unhedged, and again, I think it all depends. So I don't think there's any right or wrong answer, but I think it just depends. Why are your clients appointing you? For us, clients appoint us to manage money for them to find the best opportunities in the global market, in the growth fund. And imagine a situation where you have picked amazing stocks that did 20%, but in the meantime, the currency has moved by that amount over 12 months. Then you meet a client, and your story is, we've done great, but really haven't made any money for you because the currency hasn't worked in our favor. And finally, there are a lot of, so we obviously are aware of a number of models, theoretical frameworks, like whether it's a fundamental models that show you differences between the currencies and values. So one of them could be interest rate parity, where you compare interest rates in two countries and say, there is a difference in the fair value. But one thing to point out is that these valuation gaps sometimes may last for years. So it's not like there's a divergence and it's going to close within 1 or 3 months. Sometimes those fundamentals model can be indicating the valuation difference for some time. But overall, we stick to what we do best, which is really focusing on finding best ideas.
And,
I think that's sorry, I was going to say that is a good point, Merrick. That I read a paper. It was quite an old paper, actually, 2016 paper from Russell, where they went through the kind of pros and cons of each approach, which we can go into a bit later. But they did note that currencies can go through these prolonged return cycles, which can take them far away from what economists would consider to be fair value. And it's not rare to see the market exchange rate deviate kind of 20 to 30% from purchasing power parity rate, and we're kind of seeing that with the New Zealand yen at the moment.
Mm-hmm.
When the exchange rate is far from PPP, there is a tendency for it to eventually return to fair value. So there is evidence of trending and mean reversion in currency markets, but you're right, it certainly can take some time.
Yeah. And Marek, from what I understood, you said it is a real nuanced sort of detail thing, as it sounds like you're hedging the actual portfolio exposures. Was that right? Is that what I understood? And so if you've got, I don't know, 56% in US stocks, say, you would hedge the actual weighting you've got to US stocks rather than hedging the benchmark. Is that what I understood?
Yes, that's correct.
Say?
But if you think that both the benchmark and portfolio are fully hedged to New Zealand dollar, that shouldn't make a difference. But yes, it is obviously, if we have we obviously manage concentrations very closely, but if we had 40% theoretically in the US, then we would have a position to hedge that 40% USD exposure.
Yeah, and that comes, the way I understand and think about that, Marek, is just around your conviction around your stock selection stuff. Like,
Yes.
and what I'm talking about there, so people are aware, is that I'll find managers that we talk to, quite often offshore managers, and they'll say, oh, the right way to do it is to hedge the benchmark, because then you're not taking out your sort of deliberate tactical positions. And what they're talking about, interestingly, is say they want to be overweight US stocks, so they don't want to mitigate that by hedging directly to the portfolio. But that's interesting, right? Because then they're talking about a thematic view on the US coming into their portfolio, whereas you're talking about keeping it pure to stock selection, which is just an interesting nuance.
So on that, we are completely benchmark agnostic when it comes to actually, we do go where we think best ideas are. So I, can you imagine a situation if the benchmark has 70% in the US and we only have 40, we would be, taking a short position in the USD, which does not really reflect our portfolio. So I think if it's a fund manager who's very benchmark aware and benchmark focused, and it's not, then I think that may be an approach. But for us, it's not something that we would be doing.
Yeah, I think what you said made perfect sense as well around that. What about like a counter position to all of that, David? Do you think about? I think it was Jason Choy who mentioned it, but do you give thought to, almost like the diversification benefits of currency, also liability matching that Jason talked to as a benefit to what you're doing?
We don't concentrate on the liability matching side of things as much, but in terms of the benefits of hedging, then I guess there are benefits in hedging in terms of that additional diversification, and what Jason was saying before as well. As markets tend to sell off, so does the New Zealand dollar, and as a New Zealand dollar investor, you end up being better off. Well, the return on the currency sort of offsets the return on the actual underlying assets. So I guess on the flip side of that, the benefits from hedging and removing some of this risk, historically in New Zealand, we've received that forward premium due to the interest rate differential. New Zealand's always had that higher interest rate compared to the counterparties, and you're essentially getting paid to hedge. Mitigating some of that currency risk in the portfolio can also reduce some of that volatility and smooth out some of those returns. And it also allows you to split components. So, of your foreign investments, you can split it into, what's in the currency side of things and what's in the underlying asset side of things, which I think is what you alluded to before. I guess one point to note is for the super life diversified funds, we invest into a lot of the underlying Smartshares products, and those are benchmark tracking products. And I guess the end consumer expects that to track exactly what the benchmark's doing. So when we're looking at benchmarking, we are looking at the index methodology, trying to replicate that and deliver a return which is in line with that benchmark. And so for us, that sort of means we use the same term contracts as a benchmark, and we'd use the 1 month forward contracts and the 4 p.m. London rates and trying to replicate that.
Yeah, and I think Marek referred to, it's almost like, again, that's one of those fantastic things that there's no right or wrong answer on a lot of the time. To me, it's whether people think about it is the key one. Like I'd ask that question if I was an advisor talking to managers, just to understand how they think about it, not from a perspective of saying hedging the benchmarks right or hedging the portfolio. It's almost like, it's thinking about what you're trying to do relative to your neutral benchmark position, right?
Yeah, I guess
you're trying to match it, is what you're saying.
Yes, and one interesting point is that if we are doing exactly what the benchmark is doing, generally the benchmark doesn't make adjustments mid-month for moves in the underlying assets. So the hedging gets reset at the end of the month, and equity markets could rally 5 or 10%, and you don't end up adjusting your hedging. So even on a 100% hedged product, if you're doing what the benchmark is doing, you can end up over or under hedged.
Yep. Jason, I've got a big question for you because you're taking active positioning. in your hedging. Obviously, your portfolio is made up of all different parts in terms of active positions. Almost use that terrible word bets that bloody people use occasionally, but you've got all your active positions inside of there. And then if you end up with quite a big currency, you think the currency is a couple of standard deviations away from fair value. And so you end up with quite a big, I think you talked about a range 20 to 80 around it if you were at the bottom or top end of one of those ranges. Do you give thought to risk budgeting inside that? Do you sit there and go, oh, okay, now I assume if you were at that sort of extreme, one of the biggest contributions to your sort of, I don't know, your potential tracking
Alpha.
error, for one of a bit, alpha. Yeah, we'll use alpha. We'll just assume everything goes right. We go on the good side of the equation. Do you give thought to that?
Yeah, I mean, we monitor the hedge levels. We run our hedges on a kind of roll our hedges, on a quarterly basis. So a third, and we do that at the end of every month, and we constantly monitor it during the month for major moves in both indices and or currency. And we report to the investment committee every month the results of our hedging. So since we've been running this strategy, it's added around 50 basis points. Well, actually, sorry, that's the Australian dollar, isn't it, Toby? 50 basis points a year. I'll have to dig up the other ones for the other currencies. But yeah, it does add risk. I mean, I guess we've been.
Part of the risk management is the 80 point maximum minimum hedge ratios as well.
Yeah, so we do have those 20 and 80% that we have to stick within. In general, we've been, if I think about the Kiwi Euro, we've generally been around 50%. The Aussie's sort of generally been around 40% or 35 to 40% with the New Zealand dollar overvalued versus the Australian dollar versus fair value estimates. The US one is the one that's been, I guess, had the more volatility, and the hedge model, as I said, we did kind of back test the results over, initially when we set this up 3 years ago for 15 years, and then we updated that again about a year ago, and we have we've basically compared 4 different strategies, being fully hedged, fully unhedged, 50%, and dynamic hedging, and all of those we get when we calculate the Sharpe ratio from all of those, the dynamic hedging is slightly higher nonetheless, but it is slightly higher than the 50% hedged ratio, or passive one, if you like.
Yeah, cool, and makes sense. David, you made mention of forward point differentials. Like you said, in the past, you got paid to hedge, which is a fascinating sort of concept that people sometimes miss. Do you reckon you can explain that really simply so that people would understand what you mean by getting paid to hedge, or how that works?
Yeah, so I guess the forward point differentials are the difference in interest rates between the two countries. So, previously New Zealand's had a relatively high interest rate compared to somewhere like the US, a relatively low interest rate. Hedging is essentially selling the low interest rate currency and buying the high interest rate currency, and that reward that you're getting for that is that interest rate the forward point differential there.
So in a really simplistic sense, am I thinking about this the right way? Is say you sell $1 million, if you hedge $1 million worth of US exposure, US dollars, back to Kiwi, that physically what you're doing is you're taking your $1 million out of a US bank earning, say, 4% or 3% in the old days, putting it in the Kiwi bank earning 8% in the old days, and you're getting 5% more interest. And that's happening, those forward points are sort of hidden when you look at the track of the currency going up and down. It's X forward points. So when you'd look at that, you'd have to think, actually, I've got to remember I'm getting a bit of extra interest out to one side as well.
Yeah, correct. And that's based on the theoretical value at the time when you set those
Yeah.
currency hedges. And
Yeah.
in between expiration of that contract, your currencies can go up and down and deviate away from that fair value as well.
Yeah. And I had the good fortune to work with the legendary Dr. Leo Kripner, who not many people would know unless you wouldn't read things about who's got Nobel type prizes or something for economics. But he used to do that currency thing with the standard deviations and have little break evens according to the forward points, because he was always saying you've got to take that into account. But the key point you've made inside of that is certainly against the US, there's basically no forward points, because where are we at today? We're at like 550 on our official cash rate. They're at something like, I forget, 525, 530 or somewhere like that, are they? I don't know,
Yeah, pretty
Jason, you
close.
probably look at that. Yeah.
So I think the upper bound's at 550 as well.
Right.
And that's really been the case since the New Zealand dollar and US dollar, the interest rates in those two countries really converged following the COVID pandemic.
Yeah.
And as they increased to fight inflation, the correlation between those two have increased as well. So you've sort of seen that interest rate differential close, and you don't get that reward from the forward points in the hedging now.
And it was interesting because if I think back, and probably the period Jason referred to in one of his answers, it would have been in the mid 2010s, like 2015 and things. There were some people would fully hedge all the currency exposure like Marek does at Mint, but for a different reason. They would say, we're getting paid forward points as an extra return for doing that, and so it's actually enhancing our expected return. So that, again, no right or wrong answer. They were doing that because of the forward point differential on it. Yeah. What about, here's a big question, and anyone can have a crack at it. When I think, one of the most fascinating things I find about currency, and probably not for you, Marek, because all of your diversified funds will have the same position, fully hedged, but for those who have got a 50% hedge, how come, like I like growth funds because of my risk profile, how come I end up with more currency than, say, Jason, because he's in a balanced fund, because he's a bit timid? And because I've got more global equities, I end up with more currency. Can anyone explain sort of, is that logical? Because I've never been able to figure that one out. It's like,
So in terms of your portfolio exposure, just having more exposure to international markets, is that what you implying?
yeah, I'm saying that
Yes.
if you subscribe to the 50-50 hedging thing, which isn't your approach, as my risk profile gets greater, I'm prepared to take more risk, therefore I have more global equities. Why is it that I end up with more currency exposure as a result? And it's one of those things I always like to think about. But I'm an odd person when it comes to thinking about currency. So
almost need to split your global equity or your global equity exposure between fully hedged and unhedged, then, Anthony.
Yeah. Yeah.
Well, I guess just one from, obviously we are fully hedged, but just one from me would be just the fact that why are we in global equities in the first place? And this is because we think there are a lot of growth opportunities there. So therefore, if you are a growth fund investor, you may have more exposure to global market for that reason. I guess that we might take, but I'm not quite sure if I follow your question, because if you're 50-50, obviously if you increase your global equity allocation from 60 to 80, your currency increases, right? So
yeah,
I think maybe
it's just fascinating to think why that happens in the industry.
I think it's a couple of things, Anthony. One, it's probably the simple way to approach like different risk profiles to have a consistent, kind of 50% hedge ratio, 100%, whatever it is. But I think you do raise a good point, because I guess if we take it from the lens of maybe like in my lifetime would have X number of foreign liabilities that I'll have. Maybe let's say, I don't know, I'll go on 20 different international trips in my lifetime. Let's say I'll buy I don't know, 100 100 kilograms of meat, right? And then let's say that if we quantify, I'll spend 2 million, USD worth of, worth of liabilities, whether it's food, travel, housing, etc., in my lifetime, right? So does it make sense to match that 2 million USD with, a 50% hedged when I'm in global equities or growth fund, which is maybe like 80% of my portfolio, versus like a balanced fund, which is maybe 40 to 50%, right? It's unintuitive, because I guess what you're saying is you're increasing your foreign currency exposure purely as a function of your global shares exposure, whereas you can essentially carve those two things out, right? Like you could have an approach where if your KiwiSaver portfolio is worth $1 million and you wanted to fix your global your foreign currency exposure at, say, 500K, then you'd adjust your hedging exposure accordingly, right? So if your balanced fund has 60%, or let's say 80%, what's the mass? 60% in global shares, and you want to have 500K in foreign currency, you'd hedge roughly around 83%, whatever the numbers are. Whereas if you're going global a growth fund, which would have something closer to 80%, then you'd be hedging 60%, right? So it's almost a sliding scale. But as far as I'm aware, no one really does that in the New Zealand industry, at least, right? Because it's probably it overcomplicates things for a lot of people, right? And they probably don't think about it from that kind of matching liabilities perspective.
Probably the answer is from the advisors, actually, is that that's why we construct the portfolio to you, and we'll just tailor the currency hedging according to your circumstance. Whereas often here we're talking about diversified funds where you've got a whole range of different investors and one approach. But it is certainly, it's an interesting one to have it's one of those questions I find that is fascinating to just stop and think about occasionally.
I guess one way of looking at it as well is, if currency was a standalone asset class, it is a risky asset class, and so you'd sort of expect that to increase as you moved up that risk profile from a low risk conservative fund to a high growth fund.
Yep. So just one thing from me, because obviously just thinking about currency hedging. There's I guess there's two things which you always should consider, and one of these is just the fact that what is really your time horizon as well. So if you and we talk in the context of growth funds, where we tell our investors you should be looking 5 to 10 years. What you will find is that the currency fluctuates, but really over the long term, it doesn't. It's really hard to find a perfect spot where where you would. Well, I guess what I'm trying to say is that it doesn't really make that big of a difference if you increase the time horizon for if you look at 10 years. But also, obviously, the question is, what for example for us would have to happen to have confidence around changing our policy from 100% to something more dynamic, right? And I think what are you looking at when you look at the currency market is just a number of variables. If we could with perfect hindsight see what RBNZ is going to do, what the Fed will do, and whether we have recession over the next 12 months. Well, if you knew these three, you could 100% perfectly time your currency calls. Now, obviously, as we all well know, we don't really know what central banks will do, because that will depend on what happens with inflation over the next few months, whether this inflation story continues, and again, whether we have a global recession within the next 12 months again. It's not our base case, but there is a heated debate around that. So yeah, I guess there's just a lot of moving parts to get confidence that that the dynamic currency hedging is actually appropriate. And
Anthony, just one thing I was thinking about risk, and you were right. If we were at the lower end of our bands, around 20% hedge, we are carrying more currency risk. But being 100% hedged, I guess, is not without risk either. If you were running a fully hedged portfolio during that COVID period, the cash calls from the counterparty could have been enormous. You'd only have the benefit from the increase in the New Zealand dollar asset values as the currency fell, and you may have to sell equities at the bottom to fund cash calls to the bank as the hedges moved out of the money, or eventually the hedges mature, of course. So there are other risks as well.
Yeah, no, I don't disagree. And look, as I said at the outset, there's no right or wrong approach. One of the people who taught me some interesting perspectives on currency was a client that I once looked after, who was a private individual who had quite a bit of money. And her perspective on the Kiwi dollar was really driven by the fact that she lived in France for half of a year, I think. And so she would change her currency reporting thing from Kiwi to basically global currency when she's out of the country. And she would think about her portfolio quite differently because of almost like her reporting base. And I found that really interesting, that often as investors here, because we report everything to ourselves in Kiwi dollars, we'll sort of have perspectives and things around that, based on just simple things like how we like to report. Like, we like producing a return in US dollars. Kiwi. We think about, volatility around this stuff. There's just some fascinating things inside it. And there's no right or wrong answer.
Informally, her liability stream to her assets, right?
Yeah.
France half the year spending euros.
Yeah. Yeah, that's right. So for that time that she's sitting there, she's spending euro. But if you think about it, though, she's probably consuming the same basket of assets, which is the point that Jason Choy's making, is that she's still eating meat and dairy products and oil and things that have all got a global currency component to them. And so, it's trying to think through issues like that, and how it's coming into your exposures.
It's probably a nice little soundbite for the advisors, when they're having the conversation with the end client, actually, talking to them about what their lifestyle is. Maybe they are in, the south of France or, some exotic location 80% of the year, right? In which case, it doesn't make a whole lot of sense to actually think, and spend in New Zealand dollars, right? So
most of us just want to be in the south of France at some point for 80% of our year. So those goals that we never quite get there. No, that's cool. Okay. I think, look, the great thing out of today's talk has been the different approaches being taken within portfolios. Again, our sort of the experience that we've got within the investment industry says there's no right or wrong way to manage money, right? There's just thought out processes, deliberate things. What you're talking about, Marek, makes real sense to me in terms of your stock selection approach and philosophy. Equally, when we've talked about liabilities and things, I think thinking about that in your portfolio is important as well, through to, like Jason's comments, being Jason Lindsay, around active currency hedging. We've seen a lot of groups adopt a similar approach in terms of the hedging and unhedging at different points in that currency cycle, because they tend to see it as reverting from being over or undervalued through different periods of time. Again, David, your views on, well, we're running index portfolios here, therefore we want to sort of stay true to label on that, makes absolute sense as well. So I guess thank you for your insights and your insights today, and also just to all of the attendees today. Hopefully that was helpful in terms of just providing good understanding of what different managers are doing within their portfolios that they're managing. But we look forward to.
I'm not sure if there's any questions that anyone from
if anyone wants to ask a question, just shout out. Sorry, I forgot about that thing.
Yeah, we actually have people here.
Oh yeah, I thought I was talking to myself as usual.
I think Paul had a question about just trying to explain how hedging is done. I'm not too sure what he means with this, like the physical, like forward contracts, or does he mean conceptually how hedging works? I don't know if anyone wants to have a crack at that. If you guys have a specific approach, I imagine most of us just use 1 month or 3 month forward contracts for the most part, or
We're 3 months. Yeah, 3 months rolling.
How hedging is done.
How hedging is done. So let's say that you have 10 million of a US dollar exposure in your portfolio in US stocks. What you would do, you would sell the 10 million for like a 1 month, the 3 months, depending on obviously what are the time frames of different managers. But it's really taking if you have a long position in the portfolio, you take a short position in the currency. So therefore they net each other out. I think would be the basic concept.
And then when the contract expires within
So
1 month or 3 months time, you then crystallize any gains or losses you would have, which
yes,
would then be
that's
reflected
correct.
in your
So
portfolio.
when the settlement date comes in, you would then have to pay whatever the difference is. And within funds, it's a lot easier because this is obviously a derivatives arrangement, so that requires quite a bit of complexity. I think for individual clients, if they have to just do it themselves, that I think is quite a challenge. So therefore, using funds for has benefit of having that accessibility of hedging.
Yeah,
And
we also use 1 month contracts. So roll them at the end of each month, and at the end of each month, when it comes to roll time, we would have a panel of counterparties, so 4 or 5 local offshore banks, and we'd reach out to them for their quotes. But yeah, I guess we also offer that hedge and unhedged products, which would allow your individual, your mum and dad, retail investors to pick their own hedging strategy as well.
Yeah, and I assume that you'll have a cheeky look if there's massive volatility in the market. Someone used COVID example before to see if the actual value of your hedging is deviated massively from, say, your portfolio. I remember I can't remember which crises we were in, GFC. Everyone seemed to wake up one day and realise things like their global bonds were massively out of whack for hedging, and so had to re-establish their hedging sort of positions mid-month. There was all sorts of panic whether the market would blow up and all sorts of things because sort of a level of volatility we're experiencing. But that's just to reduce your tracking error back towards benchmark or neutral. So I guess in your case, Marek, so it's not coming through as unintended noise in your stock selection. Equally, David, for you, that you're staying close to your benchmark as well. Yeah.
I'd be
So
curious.
hopefully that made sense.
I'd be curious amongst the panelists, like how many currencies you guys actually use. So obviously global equities is, many different countries, but a lot of the time you'd proxy a lot of the smaller ones, right? But I know I was talking to Craig Coop recently at BND. He does a kind of biannual survey in terms of what the approach that different fund managers have. And increasingly, I think that kind of core basket, USD, Euro, Swiss, etc., is slowly expanding. I think it's, at least within Foundation, we use between 7 to 8 different currencies. And sometimes there's the argument that you should proxy the NZD as well to an Aussie, to the Australian dollar. So I'd be curious how you guys kind of approach global equities on that front.
93 for our funds, or our global equity fund, 93% of the positions, 93.5%, are in 7 different currencies, and we proxy the Hong Kong dollar to the US, and the euro and the Swiss, the Swiss and the pound, Swiss and the sterling to the euro, and then hedge yen, Aussie, US dollar, and euro.
Yeah,
we've got we do hedge sort of 6.5% that on top of that is unhedged.
Yeah, it sounds like a very pragmatic approach. Sounds very similar to what wealth managers do.
Yes, for us, we do all currencies. So we have USD, Euro, Swiss franc, GBP, to name a few, Swedish kronas, Norwegian. So, long list. But most of that is USD and Euro, and I think that there's a point, obviously practicality point. So if you have one stock that's a 60 basis points or 40 basis points, I mean, if you have, my point is a small holding, then there's always a consideration whether it's feasible. So that's one thing you should consider if there's a really one tiny position, whether it's actually economically viable to that would be cost analysis would take place in that situation, but that's very rare for us.
The other thing we do on our monthly performance summaries is we do explicitly set out what portion of the investor's exposure is exposed to foreign exchange movements, so that's clear for the investor.
Yeah, we've got a pretty similar approach as well. We've got, you know, eight currencies there, including the Hong Kong, Euro, Pound, Japanese, US, so all the sort of major ones. And on a you know, international portfolio, that's probably going to represent sort of 96% of, you know, a direct match.
Yeah, and so what we're saying there, to be clear, is that if you thought about a completely passive portfolio of global shares that you wanted to fully hedge, you've actually probably got 20 odd currencies in play, more 25. Back in the old days, I think the MSCI old index was about 25 different countries, whatever it used to be. You'd hedge every one if you were really trying to get it absolutely perfect. But if you do what David just mentioned and you say 8 currencies, and that's quite a few, you'd get pretty close to being perfectly hedged. The most I've ever seen a fund manager do is a basket of 15 currencies, and they were really into trying to get everything perfectly lined up. But you know, I think, Jason, you'd say, you know, groups would come along and say actually 5 would do, 5 main baskets. I think, Jason, you've said 6. Interesting. Probably an observation for me is that one of the things that I observed in all the times I used to talk to corporate investors, like superannuation schemes, often for some big industry groups as well, companies that have a treasurer there who'd be hedging stuff, they'd just be perennially negative on the Kiwi dollar. I think that as one of your biases as a person living somewhere is that you always talk down your own currency, which is fascinating. Obviously, you guys aren't talking about that in your own portfolios, but I just think it's one of those things to be aware of. That people just have this inbuilt bias against the Kiwi, and I certainly found the way to combat that when I'd be talking to these guys. I'd say, okay, you're talking about why the Kiwi will go down. Can you just talk through the rational argument of why the US dollar's going up? Because it's quid pro quo, right? If they're talking down the Kiwi, they're talking up the other currencies, and they would then realise they had no view. They'd sort of say, well, I don't know, you know, that's not what I thought about. And you'd say, well, for one to go down, the other has to go up. So, yeah, it's just one of those weird things I used to like mucking around talking to treasurers about. Normally get yelled at and told I'm a fool, but yeah, we would certainly have some fun with it. Yeah. Then I'd look up their annual results and see how much P&L they actually got from their currency positions. But that's a story for a different day. Yeah. No, so was there any other questions here, Jason, that you've picked out, or?
No, I don't think so. I think Paul just made a quick comment about basically equating hedging to a premium, which is a good way to think about it. Essentially, it's like having insurance, you know, and no hedge is perfect. It's kind of Anthony alluded to earlier. You're never going to get the 100% perfect hedge, even if the fund name says 100% hedge or whatever it is, right? You can't really compare like the theoretical benchmark performance of a hedge versus unhedged fund and be like, oh, yep, I should have hedged based on that, because there's going to be a cost to hedging as well, whether it's reflected in a higher management fee or it's reflected in the performance. So again, you just have to almost treat it like insurance, right? So, well, one thing goes wrong, nothing goes catastrophic, then you know you haven't lost anything other than premium or the cost of hedging. But if things do go catastrophic, then that's what it's kind of there for. And again, there's no right or wrong answer. No one has a crystal ball here, so.
Yeah, and Paul, to answer your question about how to do the hedging, like the best way we've found is to find a bank who's got a good hedging program. You either need to have boots on the ground as a portfolio manager with someone who's sort of specialist willing to look at this every day, or you can engage with some of the major banks will actually offer currency hedging and even to baskets of currencies for portfolios as a service. And so that tends to be how we've approached it. It's amazing how many foreign managers we deal with, or global managers that we deal with, who are like equity focused specialists, who happily you'd think, oh yeah, they'd easily go into doing currency hedging, and they'll just sit there and go, nah, we want to deal with a professional group doing it for us because it's not their area of expertise or specialty.
That's what I think the beauty of a kind of dynamic hedging model and a ladder is it removes the conundrum of what and when to hedge, given our rules determine that for us. And in a way, we kind of don't have to have currency views, which is good because I'm an equity guy. I'm by no means a currency expert, so good to rely on a framework that we back tested and will continue to do so to check it.
Yeah. And I'll pick your other question up later, Paul, offline. So can't do ads for different groups, but we can certainly give you some insights into who might be able to do that for you. Cool. So shall we call it quits because we're heading towards the weekend, and I sort of understand how busy you have to be able to knock off at 4 o'clock and have a beer. So certainly thank everyone for their attendance and insights and things, and fantastic to see everyone along, and thanks to all of audience who have attended. We really appreciate you giving up your busy time and things to come along to these sessions. So thanks everyone.
Thanks.